NextEra Energy, Inc., formerly known as Florida Power and Light, is one of America's premier utility companies. Since December 31st, 2021, the stock has fallen from $93.36 a share down to $52.78 as of yesterday's close. That's over a 43% drop and a 25% annualized loss. Is this a dog, or is this a great company that's now gone on sale? Watch this video to find out. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. This is actually a subscriber request, but it's one that I've been following. I've been looking at NextEra Energy, which is the former Florida Power and Light, and we're going to do kind of a deep dive into the stock today because like most utilities, its stock price is down significantly in value. Now, what we need to determine is, has that made NextEra Energy an attractive entry point today or not? And I'm going to let you judge based on the video. I'm going to start here by looking at some historical performance of NextEra Energy. I'm going back to the year 2023 up through year-end 2012. And what I want you to notice here, a couple of things. I've just got earnings per share, which is the orange line, adjusted operating earnings, at a 15 PE ratio on the graph. And then these are weekly closing stock prices, the black line. And what I want you to note is how, in the long run, the stock price followed the earnings during this period of time. But a good valuation reference would have been this 15 PE, or the orange line. Now, there are times you could have bought the stock when it was trading at a lower PE ratio below the orange line, and times when you could have paid a higher valuation for the stock. And you can see where it even got highly valued coming into the recession of 2008 and 9 to where it got really attractively priced. But the point I want to make here is that the stock was trading more or less around that 15 PE benchmark, if you will. Now, if I extend that out a little bit further, I want you to notice that that stayed intact through 2013, 2012, actually, the beginning of 2013, where all of a sudden the stock price began to separate from this normal 15 PE ratio line. And that continued on for several years after that. So here we have 2013, where the stock price started to trade in multiples of 20 times earnings, 23 times earnings, 28 times earnings, and all the way up here into 35 times earnings by December 31st, 2021. Now, I keep taking this forward now, and what I want you to note is that once the stock price kind of peaked out, or the multiple peaked out at around 35 times earnings, the stock has been a very poor performer since. But what I want you to really focus on is the earnings of the company have been traditionally, customarily about the same as they've always been. It's been averaging over this time frame I've got on the graph now from December 31st, 2006, which is approximately a 19-year graph including estimate data. The stock has averaged 8.64% growth. If I shorten that to an 8-year graph, growth accelerated to about 10%, but that still wouldn't explain these high valuations that we saw in the stock during this period of time. All right, maxing this out at now and kind of summarizing what I've covered so far, based on earnings, the company tracked a 15 PE ratio more or less through 2013, starting in about the spring of 2013. Then we start getting these high valuations. But I want to take real notice here of what valuations tend to do to a stock price. Once the stock really got highly valued, we'll say here it hit 30 times earnings in August of 2020, for the next several years, not counting the more recent drop, the stock only averaged about 1.75% a year annualized. It actually had a capital loss during this period of time. Yet, if I look at the earnings of the company, we had some of the best earnings years they've had in modern times. We had 10% growth in 2020, 10% in 21, 14% in 22, etc. And this has a fiscal year end of December. So what we're seeing here is really the effects of overvaluation. But I also want to point out overvaluation lasted a relatively long time. Now, we could have discussions about interest rates. Yes, interest rates were lower for much of this period of time. The company is a major investor in renewable energy, and that's why they changed their name to NextEra Energy from Florida Power and Light, because right now the company operates in 40 states in the U.S. and 4 provinces in Canada. It was founded in 1925. It's a dividend champion. They've increased their dividend for 25 consecutive years. It serves nearly 10 million people with approximately 5 million customer accounts. Their primary subsidies are Florida Power and Light, which is their regulated utility, and Gulf Power Company. And Next Energy Resources, called NWER. NextEra Energy Capital Holdings is also a wholly owned subsidiary of NextEra Energy, and it owns and provides funds for NextEra Energy Resources. That's a mouthful, actually. And other operating subsidiaries apart from Florida Power and Light. In 2014, NextEra Energy formed Next Energy Area Partners LP, which is a separate company, and we might take a look at that real quickly, to own, manage, and acquire contracted clean energy products. So this company is all about clean energy. They produce a large volume of electricity from wind and solar. But what I want you to note here is look how consistently this company has grown earnings. If I take price off of this graph, what you're seeing here is a quintessential growth rate averaging over 8% going back, all the way to from fiscal year end 2002. This is almost perfect performance. You can also see the dividend line here. The dividend has increased dramatically. And then if I, put dividends on top of the graph, you can see that shareholders have also received a generous payout ratio. About half or more of the company's earnings have been paid out in dividends. Right now, the stock has an earnings yield of 5.81%, so it's getting close to my 6.5% earnings yield that I prefer as Mr. Valuation. It has a dividend yield of 3.54%, which is attractive even in today's interest rates, especially considering the consistent growth in dividends, which we'll cover here in a moment. The company can be bought at a blended PE of 17.21. I'd like to see it at 15 times earnings for me to really be interested. It's A- rated, has 52% debt, and according to Morningstar and Zacks and other firms, this company has really got a very strong balance sheet and a good liquidity position. However, the company's become very aggressive recently in investing their money into new power sources. That's had an effect on their free cash flow, which I'll get to. But looking at the stock price and then adding the market multiple to this stock. Now, historically, going back using the scroll bar feature, the analytical feature of this tool, if I go back in time, you can see a 14 to 15 multiple, 14.5 to 15 multiple was the most common multiple for this stock up through 2012, as I mentioned earlier. Then as you fast forward, the multiple since 2013, actually, I can take this back a couple years, has averaged about 24 times earnings. So we've had this very high period of very high valuations. And of course, that's had a real impact on what the performance of the stock has been able to do. But once it became overvalued here, it kind of got very volatile for several years and then stalled. And this is why I say measuring performance without simultaneously measuring valuation is the job half done. What happened is the company, in my opinion, hit the headwinds of very high valuation, even though it had superb operating results during this time. But let's look at some other metrics now. Let's take a look at operating cash flow, which is very important to the dividend investor. Now, from an operating cash flow point of view, the company has traditionally sold at around 9 times cash flow. It's currently in line with that at 9.4 times cash flow. You can see that's the blue line on this graph. That's the normal price to cash flow. But even more importantly, what I want you to note here is looking at it from a standpoint of dividend coverage, whether this cash flow line, the orange line, is above the company's dividends, and you can see the company's produced ample cash flows to cover their dividend. Now, when we then look at the all-important free cash flow per share, we also see some, a little bit of a different situation here because this company is really CapEx heavy, and they're going to be doing a lot of CapEx here in the future. And we're going to talk about that, in a moment. That's really destroyed their free cash flow. But what they're doing is they're investing significant amounts of money in solar and other renewable energies that their CapEx is going to be very high. And I'm going to invite my son Colton to come in and take a look at what their investments are going forward, their capital expenditures, and even some of their liquidity by going through the financial statements for you. And then I'm going to come back after he does that and look at the company. But before I turn it over to Colton, let me look real quickly at a couple other metrics. If looking at earnings before interest, taxes, depreciation, and amortization, EBITDA, the company has typically traded at a normal price to EBITDA of about 7.76. That's almost precisely where it's trading at now. So valuation is starting to come into alignment, into a rational view. As far as price to sales, it's still trading a little high on a price to sales basis. And again, from adjusted operating earnings, I'd like to see the stock trading in the 40s before I became interested. But the question is, I do believe you could start building a position in this stock, and I'm going to be looking at the future opportunities from here once I turn it over to Colton. So right now, let me turn it over to Colton to go through the financials with you.
Hey everyone, Colton Carnevale here with Fast Graphs. So as Chuck said, we're going to be taking a look at the financial statements of NextEra Energy. So I'm going to be looking at the last 5 years primarily. And what we'll do is we'll start with the income statement, balance sheet. Well, let's go income statement, cash flow statement, and then we'll take a look at the balance sheet finally. So I want to take a look at the sales revenue. Let's just go top down and take a look at some of these values. This is a new feature I love that we've added recently, by the way, being able to create these charts. So for every single one of these items in the financial statement, we can generate these charts. And as we can see, over the last 5 years, we've seen a 62.77% growth rate in revenue for NextEra Energy, a 10.23% compound annual growth rate. So revenue is growing nicely, especially over these last few years. It was pretty low growth here, but if we shorten this even slower, over the last 3 years, we've seen 55%. So pretty fast growth in terms of sales in itself. When we get down into the cost of goods sold, we are seeing growth in there. That's natural to see growth in cost of goods sold. But what is nice is we have seen a nice bit of growth in the gross income. So they are getting, they're getting more efficient, at least from a cost of goods sold, or at least a gross margin standpoint. So sales seem to be outpacing their cost of goods sold. That's great to see. So we are seeing some margin increasing, some efficiency getting better in that sense. And then coming all the way down here, I'm not really going to worry much about much else. We are going to take a look at the net income. Net income is decreasing a little bit. They're becoming a little less efficient, so they're having a little bit higher expenses on, throughout the income statement. But I don't think it's really much of a worry. Once again, they are becoming slightly less profitable, but they are, they're spending a lot and reinvesting a lot in this firm. And we're really going to see that on the cash flow statement now when we jump over here. So as Chuck alluded to, the free cash flow has been going negative. But what is nice to see is the net operating cash flow is increasing nicely. So we've seen a 27% growth rate in net operating cash flow. It's gone from $6.4 billion to $8.2 billion. And as we can see, that's the net operating cash flow starts with net income and then adds back all of these non-cash charges. So net income, once again, has been dropping, but net operating cash flow has been increasing. So most of those expenses are coming from the non-cash charges. So depreciation, depletion, and amortization, this is a non-cash charge that has been increasing. 2.6 billion to 4.7, that's increased by 81% total growth. So a lot of that profitability that the company is losing is coming from its non-cash charges. It's coming from its amortization and depreciation, where we actually are seeing a growth in the cash itself. But as Chuck said, we've actually seen a decrease in free cash flow pretty significantly. And that's due to the pretty large increase of CapEx. So this is a cash outflow, it's a negative number. So just interpret these as like a positive growth rate, if you understand what I'm saying. The CapEx has grown by 78.92%, or 12.34% per year, a compound annual growth rate. So they are investing a lot into the infrastructure of this company, and Chuck has touched on that. So if we scroll all the way down to the free cash flow, we are starting to see negative values in free cash flow. And then finally, even though we're seeing some negative values in free cash flow, net change in cash, it's staying, they're having some negative years and they're having some positive years. And we'll go take a look at the balance sheet here in a minute. But one thing that we do want to pay attention to is, where is that funding coming from? So they're getting $8 billion, $6 to $8 billion in cash from actually the business generating the cash. They're having big outflows for investments. So, they were spending $8.9 billion back in fiscal year of 2017, where they've now spent $18 billion in investments, purchasing investments. Well, $14 billion in purchasing and investments, but $18 billion complete outflow. That's including the CapEx for investments. So, this is a large growth rate of them investing in the firm. Essentially, all of that cash is hopefully going towards a good investment and potentially a great return for the investor. And then finally, financing cash flow, right? So to offset that large increase of investment outflow, they've had to have a large financing inflow. We've gone from $2.8 billion to $12 billion. So we've seen a 324% growth rate of the inflows from the financing. And we can see that's primarily from the issuance of debt. So we've seen a increase of issuance of debt. They issued $3.4 billion back in 2017, all the way up to $10.2 billion in 2022. So we've seen a large increase. Most of their funding is coming from debt. So they are raising quite a bit of debt. That's something to keep in mind, especially as interest rates have significantly increased through, 2021, 2022, and 2023. But one thing that we can see here is not much of it is coming from dilution. They are selling some stock, so there's a little bit of shareholder dilution, but doesn't seem to be much. And most of their money is coming from the issuance of debt. So once again, the net change in cash, they're maintaining mostly a positive cash inflow, but they're having some larger outflows, like $4.1 billion back in 2019, and then $230 million in 2021. But we've seen $2 billion this past year, $3 billion back in 2018. So finally, I want to take a look at the balance sheet. Here's where we're going to take a look at some assets, cash and everything like that. So, we are seeing the ups and downs, like we just saw the net change in cash. Cash and short-term investments is changing. We've gone from $1.9 billion to $1.6 billion. So a little bit of loss of cash, 16%. So, but they seem to be maintaining it. They are, once again, funding it mostly with debt. And then I do want to take a look at the total assets and then compare that to the liabilities. So we've seen a pretty large growth in assets, 62% growth in assets, in total assets, where 10.16% compound annual growth rate. We've seen a 60% in total liabilities. So liabilities are increasing almost in line, right, with total assets, but total assets are outpacing liabilities. So we should see a growth rate in equity. And we are seeing a growth rate in equity. So this firm is still providing a positive return for shareholders. It's creating value for shareholders. We're seeing assets increasing. And one of those largest asset increases is in the net property, plant, and equipment. So, CapEx is going into this pretty heavily. So, they're using cash, converting that cash into property, PP&E. So, they're reinvesting back into the company while still maintaining growth of shareholder equity. So ultimately, that's how this firm is capitalized. If we go back here and take a look at the historical chart, we can see the long-term debt to capital. So capital is equity plus debt. So, they're mostly funded from debt, but it's about half and half. It's about half debt, half capital, even with the larger increases of debt recently. And they still have great credit rating, A-. It's a solid company. I think they're pretty well capitalized. They are positioning themselves for growth. We are seeing growth in the operating cash flow, which is awesome to see. That means the business itself is generating more money. So, this could potentially be a really good investment, especially with this drop in price that we're seeing. I'll let Chuck cover that, but ultimately, I believe that NextEra Energy is pretty well capitalized. The con that we do need to think about and watch out for is the debt. and when that matures and the interest payments on that debt. And just one last thing that we could go check is the interest payments that they are paying, and that would be under the income statement. And then down here we have interest expense. So interest expense isn't increasing all that much. Well, 37% over these last 5 years, but 6.56% compound annual growth rate. So, I mean, I wouldn't say it's that large. Their revenue is obviously increasing a lot more than that. So they are increasing their top line by reinvesting more than their interest is. But as long as they can maintain and cover those interest payments and that debt, I believe it should be a pretty solid company that is well capitalized. Thanks. Back to you, Chuck.
All right, thanks, Colt. That was excellent. This is Chuck Carnevale back again. Now, what we're going to do. We've looked at this company. I'm going to go through some other research here with you, and I'm going to look primarily now to what the future opportunity for NextEra Energy might look like. So let's go ahead and get into that. The first thing I want to do before I do that, though, I want to finish up history by looking at performance. I want to make a point that because of the exemplary operating history of this company, and even considering the high valuations it's historically traded at, if we look at long-term performance, a $10,000 investment in January of 2003 would have grown to $69,000 by yesterday's close. Add in another $22,000 in dividends, and this is almost a 10-bagger. It turned $10,000 into $90,894, averaged 11.22%, and that beat the S&P 500 from 11% compared to an 8.5%. The dividend growth has also averaged over 9% a year, and it's been consistently growing the dividend at that rate. I want you to note that before we go looking at the future. But I also want to point out that this performance is after the stock market has fallen, as I pointed out earlier, for these last 4 or 5 years. So even though the stock still has some ways to go, in my opinion, to where it would become really attractively valued, it's now really coming into a range of valuation that's starting to make sense. So let's look at the forecasting calculators. Now, what we have here is we have 16 analysts, 17 analysts, and 17 analysts for 23 and 2024. These analysts have been maintaining their forecast for 312 for 2023 and 340 for 2024 and then 367. And that's going to be for an average of about 8.3%, which is about what the company has historically achieved. That's going to be okay. But now looking at the analyst scorecard, how accurate these analysts have been, with both a 1-year forecast with a 10% margin of error and a 2-year forecast with a 20% margin for error, the analysts have got this company right almost perfectly. So these estimates, I would put a lot of confidence that these estimates are probably reasonable for this company going forward. Now, if we bought the stock today, at the $52, and if I go into, another service here, we'll go into Yahoo here, because I also want to check estimates on Yahoo. The stock is down 3% today to $51 a share. Analysts expect the next 5 years to be 8.8% on Reuters, which is what Yahoo uses. And we're looking at the 312 and the 341 for next 2 years. So, we've got consistency across the board of analysts that are, forecasting future growth for this company. If we bought the stock today and it did grow at the rates that the FactSet analysts are saying, and it traded at a 15 multiple, then you would have a rate of return of about 5.74%. If the stock traded at its normal 5-year multiple, that would be 38.58% you would expect to make annually investing today. Now, I think that number is a little unrealistic because I pointed out I found it was really overvalued. So if we look at a more normal PE of 19 over historically. In other words, this is a premium A-rated company. It does have, modest levels of debt, although it is taking on more debt, as Colton pointed out. But, we could be looking at a 16.67% annualized rate of return going out. But using the more conservative number, I would like to see the stock drop further. Now, down another 3% today, it looks a little better than what I'm showing you here. But you can see the valuation corridor here, these orange lines, assuming that valuation is never perfect science. This stock is now more attractive than it's been. And again, if it trades at premium multiples, you could make a great deal of money. If it trades at normal, more realistic multiples, you could still make money here. But again, my view would be I'd be looking for this stock to, be a little cheaper before I wanted to buy it. But certainly NextEra Energy has now come into reasonable valuations. Now we can talk about interest rates. We can talk about interest rates rising is why it's come down. We could talk about this company going forward. There are many things they've done to mitigate the rise of interest rates. They've been reducing costs. The company does plan, as we mentioned, invest over $52 billion, almost $53 billion from now through 2027 to strengthen its infrastructure and add many more megawatts of power through solar and other sources of energy, including nuclear. There are some risks to the company. There's obviously it's a regulated utility. That's always a risk. The company does depend as a regulated utility on the Florida Power Commission to, give them the proper rate increases that they need going forward. The company, again, they're adding a lot of renewables. They have a big backlog of renewables right now. So all in all, this company might be one you might want to put on your watch list. It's starting to get very, very attractive. I don't think it's quite a buy yet from my own, what I'll call a very nitpicky look at valuation. But if you're looking for a good utility and wanted to start building a position, it might make sense now. I don't know that the bottom's here. I don't know that we'll know what the bottom is. But the point is, after a long period of time of being overvalued, you can now buy NextEra Energy within some reasonable valuation levels. And again, I would like to see it a little cheaper. But certainly for the quality of this company, I don't think you go wrong long term investing in it today and having a commitment, especially being able to add more money. And you might even want to reinvest the dividends if growth is your objective. Anyway, thanks for watching. This was an investor request. Quick look, kind of a quasi deep dive into NextEra Energy. I want to point out you can go to the company's website, and if you do that, if you go into the company's website, if you're a FastGraph subscriber, you can go to external links, go into the company's corporate website, and there you can find things like investor presentations where you can learn an awful lot about the company. And, they're pretty transparent. I think that's part of the reason why analysts have been so consistent. I'm not going to go through this with you today. You can also look at other sources like Morningstar and, other research services. Morningstar gives it a 5-star rating right now. I think that's a little aggressive. But anyway, this has been Chuck Carnevale, aka Mr. Valuation. Hope you enjoyed the video. If you did, give me a like, ring the bell. Thanks for watching. And, take a look at subscribing to FastGraphs. What a great way to be able to evaluate stocks. You go through the financials like Colt showed you. You can look at all the various metrics like I showed you.